The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
A solid U.S. economy or cuts to interest rates? Investors weighing which is more important. Live from Studio 2 here at Bloomberg headquarters in New York, I'm Romaine Bostick.
And I'm Matt Miller. We are kicking you off to the closing bell here in the U.S. Let's get a check first off on where markets stand. Down for a third day in a row on the major equity indexes. You can see the S&P 500 now at 6,600 even, down 0.5%. The NASDAQ falling 0.5% as well. Not quite as far, but you do see some of the big tech stocks dragging us down. Notably, Tesla is a big loser today. I'm also watching the front end of the curve climb a little bit higher than the back end, up 5, almost 6 basis points as this strong economic data, Romaine, puts people off of Stephen Miron's idea of big, steep cuts over the next couple of Fed meetings.
Yeah, and it was that batch of robust economic data that really is calling into question the need for looser Fed policy. That includes the upside revisions this morning to second quarter GDP, as well as separate data for August showing business equipment orders up, merchandise trade deficit narrower, jobless claims pulling back, and that has traders pulling back too, backing away from bets for 2 additional interest rate cuts by year end. Chicago Fed President Austin Goolsbee rebuffing calls for front-loading multiple cuts. His Kansas City counterpart Jeff Schmidt suggesting the same, but FOMC members are far from aligned on this matter. Vice Chair for Supervision Mickey Bowman citing a weakening job market as cause for cuts. And as you just said, Matt, Trump acolyte Stephen Miron pointing to a neutral rate that he sees as growing economically restrictive.
My view is not one of enormous economic pessimism. I don't think the economy is about to crater. I don't think the labor market's about to fall off a cliff. However, the neutral rate is drifting down. And as a result of that, it's incumbent upon policy to adjust in response. And the longer that policy stays excessively restrictive, the greater the risks to the downside for the economy.
And we're going to circle back to that conversation in just a moment with Anne Walsh over at Guggenheim. But, Matt, I do want to flag another development, and that's the uptick that we've been seeing in the VIX, which is on pace right now to do something that it hasn't done since February. That's actually rise for 2 consecutive weeks. Expectations right now of stock market volatility over the next 30 days showing a bit more cautious, particularly coming off of those record highs, Matt, and now the guessing game over where rates go.
All right, I'm focused on the economy and using this Bloomberg tool, eCan Go. You can run a number of data points through it, and it breaks things up nicely. Stephen Miron says Fed policy is economically restrictive, but how then do we get 3.8% GDP growth? Well, part of it is just that we're not importing as much ahead of tariffs, but rather exporting a lot. And another part of it is personal consumption. We're just buying a lot more stuff than may previously have been expected, Romaine.
Absolutely. Let's kick things off to the close with Anne Walsh, Chief Investment Officer of Guggenheim Partners Investment Management. Anne, great to have you here on the program.
Thank you for having me, Romaine.
There is a lot of talk right now about whether right now monetary policy should be considered restrictive or not. And I'm curious as to how you view it from where you sit.
So what we've observed for quite some time, actually, we've been in this circumstance for several years now, and that is we have a bifurcated economy. There's the haves and the have-nots. Small businesses, lower-end consumer, they've been suffering. And to them, the interest rate environment is very restrictive. Their cost of borrowing is high. The delinquencies are rising. That's been challenged. On the other hand, companies with access to capital, large issuers, those with more wherewithal, and the higher-end consumer, it's a totally different story, especially as we've seen the wealth effect being driven by the stock market performance. Mm-hmm. And so when, Matt, you're referencing the consumer, well, the strength has definitely been there. The top 10% of wage earners are consuming at 50% of the consumption level. So we're seeing a very different kind of economy depending on where you sit.
Well, it raises the question, though, is monetary policy, at least in this traditional mechanisms, the right way to address some of those disparities? And just earlier today, we heard from Lori Logan, who even raised the prospect of maybe we should rethink what the benchmark rate is even supposed to mean.
So I tend to believe that we have more room for cuts. Mm-hmm. I've been advocating for rate cuts for a bit of time. I also think rate cuts at this phase of the economic cycle are a bit of a blunt instrument. And I don't think the Fed has used the balance sheet maybe as precisely as they could have used that. It has a different effect on the economy. I think rates should be coming down. Even the Taylor rule suggests that they had 75 basis points of cuts left in the system. We started with 25. We still think that's 2 cuts left. before you get to what at least the Taylor rules suggest is neutral at this point in time.
So what kind of terminal rate do you expect? The market is pricing in 3%. And to be fair, Myron says he thinks the neutral rate is 0. So, add inflation to that and you get to that rate.
So I'm a little bit more middle of the road. I'm certainly not at 0. I think we have a few other aspects to the U.S. economy as well as the global economy that are happening. We're kind of in a bit of a reflationary world, and I don't want to mean inflationary, but there's a lot of positives and there's a lot of growth. You talk about the GDP number that came out today, a surprise on the upside, 3.8%. But we have artificial intelligence build out, data center build out. It's adding 1% to GDP. We're looking at a tremendous amount of productivity. But all of this does have a somewhat inflationary pressure level to it, in a good way, because it's adding to the growth of the economy. And it's not, again, just in the U.S. This is globally. And so as a result, I think a 3% number on the terminal rate makes sense currently. Unless you're to see a slowdown, which isn't really our base case, then we would reflect at that point in time and say maybe it's got to be lower than that, maybe 2.5%. But I think for the time being, you get a real rate of interest that you can earn as an investor, and I think that's relative and relevant to investors.
Is it possible, Anne, that we get inflation hovering around that 3%, which seems to be where the Fed is comfortable? I mean, they talk a big game about 2%, but we know they don't mean it, and that we get growth that's maybe even stronger than the 1 to 2% that people are expecting? Everyone's waiting for this other shoe to drop from tariffs, but we keep waiting and waiting and waiting. And in the meantime, we're seeing some real economic success.
Indeed. And the truth of the matter is that, we've got a complex economic story right now, right? You have tariffs, as you mentioned, the concern of whether or not they're really inflationary or not. I think they tend to have more of a slowing effect on the economy relative to an inflationary effect. And so we really don't believe we're going to see that much impact from that. Additionally, we do have quite a bit of growth in the system. And in areas that we probably didn't take into account as prognosticators when rates were rising was the fact that there's a whole savers benefit out there too, and benefiting companies with cash on their balance sheet as well as traditional savers like maybe older Americans, for example. So there's a lot of tailwinds in the system at this point in time. So let's go back to the question of whether inflation at 3% is really the Fed's target now. I would suggest that they've moved slowly and sort of quietly into a range of inflation that's acceptable, particularly when you have high productivity, which we're starting to see that. And again, the benefits and the use cases for artificial intelligence usage are also going to benefit productivity quite a bit. You adjust that 3% or sort of in the mid 2s. Sounds like it's actually not only achievable, but well within what the Fed could tolerate.
I am curious, if we do sort of are at the start of a prolonged rate cutting cycle, or there's just some sort of prolonged easing here, what does that mean for a lot of the folks who are right now piled into short-term treasuries or short-term debt overall? Does that rotate out into longer-term debt, or does it rotate out of short-term debt altogether, out of debt markets altogether, and maybe into something riskier?
So we would anticipate that there should be movement into the longer end of the curve, and that would make a lot of sense. You're getting paid as an investor in terms of nominal yields, and even if you look at real yields for the first time. You also get a very nice risk premium relative to, say, equities, where there's no real risk premium at this point in time. So it suggests that of the $7 trillion that's sitting on the sidelines, that there would be benefit from extending. Plus, we are seeing an increasingly steep yield curve, which benefits the longer-term investors. So all of that benefits the fixed income extension trade, if you will. And particularly as we see that rates are in a trading range at the longer end of the curve. We're really kind of stuck between mid-3s, mid-to-high 3s, and mid-4s. And so that lends some stability for investors as well.
All right, and great stuff as always. Anne Walsh, one of the best in the business, Chief Investment Officer over at Guggenheim Partners Investment Management, kicking us off to the close here on this Thursday afternoon as we await to hear from President Trump, expected to sign an order on that long-awaited TikTok deal. We're going to discuss the potential implications of the announcement on some of those content creators, Matt.
All right, and an exclusive interview with the CEO of CoreWeave, Michael Intrator, will join the program fresh off the news that his company is expanding its agreement with OpenAI to meet demand for AI computing power.
We're also going to hear from the CEO of Klaviyo, Andrew Bialecki, going to be joining us to share his insights on the consumer and spending on the back of that robust economic data that we got earlier today. This is The Close on Bloomberg. All right, time now for our top calls. Big movers on the back of analyst recommendations. And let's start off with Wendy's. North Coast downgrading to sell with a $7 price target. The analyst says Wendy's needs new leadership, a marketing revamp, and a same-store sales boost to get back on track. The shares, which are already down 40% year to date, down a couple more percentage points here to the lowest levels intraday since March of 2020. Next up, Oracle, Rothschild Redburn initiating new analyst coverage with a sell rating and a street low $175 price target. That's a contrarian bet, to be sure, the only sell-side bear on Oracle, warning to investors that the company's cloud revenue outlook may not fully materialize. Those shares down for a third day. And finally, let's take a look at Alphabet. MoffettNathanson hiking its $230 price target to $295. That's the second highest on the street. The analyst citing the Google parent's strong position in the AI race, calling it a company that should rightly be considered for the title of the most valuable in the world. The shares pulling back slightly here on the day, and those are some of our top calls. But let's bring in the analyst behind that last one, Michael Nathanson, Senior Managing Director and Senior Research Analyst over at MoffettNathanson. And we should just point out, this is still the fourth most valuable company out there last time I checked, but it's still got a ways to go, at least another $1 trillion in market cap to get it up to the biggest company in the world. What, Michael, if anything, gets it there?
Hey, well, thanks for having me on. I think it's a recognition that AI is not as big of a threat as maybe the market thought initially, right? This company has had a great third quarter, no doubt, being revalued. If you go back to the start of when OpenAI and ChatGPT came to the market, Alphabet stock price has derated, its multiples derated. So I just think it's a recognition that, look, they had the lead in Gen AI. They lost it, and they let ChatGPT move to a first mover advantage. But since then, they've been very good and very smart about innovating and delivering products that I think are very competitive with ChatGPT. I think it's that recognition that they have a ton of assets here that benefit from the pivot to Gen AI.
I am curious as to whether that benefit is more kind of what's going on behind the scenes with regards to their cloud and cloud infrastructure business, or is it going to be more the consumer-facing side of this company, meaning, the search box or what is now effectively, the chatbot box, if you will?
Yeah, I think it's a little bit of both, right? So cloud is growing very nicely. It's re-accelerating. They've said to you that the growth is restrained because of capacity constraints, but that should be working its way. And then on the consumer side, we've got things like YouTube, which will get better and has been doing well, to date. Search, to your point, it's either search through AI mode on your search app or Gemini, standalone app, and then also Waymo, which is starting to really pick up steam, which is, autonomous vehicles. And that's going to be another product we see. So I think it's a little bit of both. But the company has, I believe, 7 products with more than 1 billion users. It is an incredibly strong, well-run company when it comes to consumer products. I just think you'll see kind of it stepping up its innovation ramp over the next couple of years as it delivers more AI products.
Of the hyperscalers, if you leave out a company like Oracle, which I don't know if that counts as a hyperscaler really, Google's the biggest gainer. But I've noticed that IBM has made some substantial progress in quantum computing, as is shown by its work with HSBC that was talked about this morning. What do you think Google is doing in that area, and does it need to catch up?
That's a great question. I don't have a great answer for you. It's not an area that I focus on. In terms of their cloud, you're just seeing the proof points from the number of big logo wins they've had from all the unicorn Gen AI companies. Even people like Apple, the largest competitors Meta have moved to their cloud. So I am I don't see them as a quantum computer in play. I think they have so much opportunity ahead of them. I'll pass on that question. I'll come back on air when I do more work on it. It's just not, for them, the opportunity set is just delivering more cloud compute for people who want, best of class, Gen AI compute.
Michael, the reason I ask is that Romaine had an interview a couple of days ago with Jeffrey Hinton, and he seemed to say, they were ahead on AI, on chatbots, and they chose not to release it until OpenAI forced their hand. And that makes me wonder, what else do they have up their sleeve?
Right. Well, it's funny you say that. The whole other bets division has a ton of products. They have robotics in there. They have, health products that are driven by Gen AI. That's where Waymo came from. Yeah, there's a ton up their sleeve. And I think what's happened the past year, the speed to market is picking up, right? I think they realize you can't sleep on the lead. I think they're very concerned about brand quality, brand safety, liability issues. I don't know if he said that to you on air, but I think they're very reluctant to launch something with any type of consumer harm in it. But I think going forward, they're going to be more aggressive by getting things in their portfolio out to the public.
Yeah, autonomous driving and robotics, those are some of the reasons that Tesla's worth $1.5 trillion, and maybe Google could get the jump on them as well. Michael Nathanson, great to get your take out of MoffettNathanson, one of the analysts that we follow the most closely. Coming up, President Trump is expected to sign an executive order approving a deal on TikTok. Up next, we're going to discuss what it could mean for the creator community with Amber Benz-Box, co-founder and president of LTK. This is The Close on Bloomberg.
We are expected to hear from President Donald Trump in moments, where he is expected at the White House today to sign an executive order approving a deal to sell TikTok's U.S. operations to a consortium of U.S. investors that we are told will potentially include Oracle and Dell. Joining us right now to discuss what this means for the content creating community is Amber Benz-Box. She's co-founder and president of LTK, a shopping platform for creators. And Amber, I do want to start off with this idea. There's a lot we don't know about exactly how this deal is going to work. One thing we do know, this is not going to be a seamless migration. Basically, we're talking about a complete reboot of the app. And I am curious that when you look at the effectiveness in the past of TikTok for creators, can they sort of recreate that lightning in a bottle with a completely new app that they have to sign up for again?
Gosh, the algorithm really does matter, and that's what TikTok really introduced to the U.S. market that changed everything in this space. So the algorithm that they've been operating on is really world-class and has set the standard for all of the other platforms that have come in behind them and really, copied that model. I want to contrast that with what we've seen in the UK. LTK is a global business. And with our UK counterparts, what we've seen is that the algorithm has actually not been as good there because they have a higher privacy threshold there than in the United States. So customers have just been less interested. And I think that that's the risk as we move into a new platform with a new algorithm built here in America is, can it compete for user attention? Because ultimately, all of the social media platforms today have moved beyond social following and connection into broad entertainment and discovery. And that algorithm is going to make a huge difference.
I am curious, where are people going? I know where sort of people are right now, but we talk about how nimble we've seen in the past of people switch platforms as they find something that maybe connects with their audience in a much better way. Is there already a shift afoot, or are people just kind of waiting to see what happens?
This saga with TikTok has been going on now for quite a while. It feels like years at this point. And, earlier this year, we saw what it looks and feels like when a platform is turned off. And it became very real for TikTok users specifically. Over the course of the last several years, you've seen platforms move from feeds that are about following and about communities into those algorithmic feeds that are much more about interest. Even today, Adam Mosseri came out and said they hit 3 billion monthly users and that they're going to continue to push into recommendations when it comes to feeds. So what that means for following and communities is that people have broken off into their niche, and there's been platforms developed to do specifically what those communities do. I'll give you a few examples. My husband's a runner, so he's an ultra runner. You know, they say the run didn't happen if it wasn't on Strava. You see a really scaled platform that's all about running and workouts, and it's a really connected community. It's standalone. I would say similar to that would be another example, LinkedIn. If you're going to try and follow someone professionally or understand what a group of people are doing or follow a topic within that category, you're going to go to LinkedIn. Similarly, with LTK, we've been able to develop a creator-led social app to where if you care about actually following creators and actually then being able to connect with them and shop their lives, you're doing that on LTK. And today, 38% of Gen Z and millennial women in the U.S. are using LTK. So we've already seen that creators are reaching out, they're finding their new home bases. They're now treating social media as an optimized marketing machine. So imagine that the algorithm is really feeding you highly qualified leads, but it's then up to you to take those 15 minutes of fame and then take it home to a real business.
So I wonder about, I don't use TikTok, but sometimes I'll scroll through Instagram or Twitter, and I see a lot of stuff that now appears faked. How important is realism in a world of AI?
Gosh, this is what has changed tremendously, especially in 2025. So in 24, we saw that our feed shifted from being following the people and communities that we chose for ourselves to it being all recommended content. This year, we've seen that shift to where a lot of what we're seeing, if not most, is AI-generated content. And audiences really don't know how to think about content that is either obviously AI-generated or not, and how it's sitting adjacent to what would be real content. So think about the brands, the creators that are making real human content, but they're sitting adjacent to something that's either or unknown as fake or false. So what you're seeing is an unintentional loss of trust on these platforms. That has actually showed up in our consumer studies. We work with Northwestern every year to see what's happening on both with CMOs and with consumers. What we found is that year over year, we've seen the largest leap and growth in consumer trust in creators. It grew over 20% year over year. I can only point to the proliferation and discussion around AI as being the reason that people are looking to find real humans to trust. This is a big deal when it comes to the advertising market, because of course, when you move to an algorithmic feed, you're able to keep someone on site for longer. But what we've seen is meaningful declines when it comes to engagement. That engagement is happening in those niche communities we talked about earlier.
All right, really fascinating insight. Appreciate you joining us. Amber Venz-Box there. She's the co-founder and president of LTK. Coming up, the Trump administration reportedly seeking a stake in Lithium Americas. We reported that first on The Close. World-renowned economist Jeffrey Sachs joins us next to unpack the implications. This is The Close on Bloomberg.
.30 p.m. here in New York. This is the countdown to The Close. I'm Romaine Bostic.
And I'm Matt Miller. We are looking at a situation where this morning we had a number of former Fed chiefs, including Alan Greenspan and Ben Bernanke, as well as other former Treasury officials, write an amicus brief to the Supreme Court saying that Trump's bid to fire Lisa Cook would harm the Fed's independence. And now we're getting more news on Lisa Cook.
Yeah, we're expecting a little bit more on that. And it kind of really brings, I think, to the forefront the idea of this intersection between what's happening in Washington and what's happening on Wall Street. There's been a lot of talk, Matt, of course, about Washington policy driving the markets. I mean, we were talking about some of the investments that the government has actually made or investments that the government has nudged other companies to make, and this idea of whether that is good governance and, more importantly, good economics.
We are talking about potentially a diversified sovereign wealth fund, right? Lithium America shares more than doubled on reports that the Trump administration was pursuing a stake in the company. And to be fair, it's a very small company to begin with. But that's just the administration's latest play at getting involved in a public entity to further its economic agenda, following stakes in Intel and MP Materials earlier this year, not to mention a golden share in the U.S. Steel Nippon Steel tie-up. Our next guest is an expert on the art of statecraft, having spent years building up Europe's economy post-communism, and he spends a lot of time with world leaders from around the globe. Joining us now is Jeffrey Sachs, professor of international and public affairs at Columbia University. He's also chair of the United Nations Sustainable Development Solutions Network. So talking about a lot about the climate change that President Trump called a giant con yesterday. Let me first, though, Professor, ask you about this this administration taking stakes in private or public companies. What's your view on building up a national security interest in chip makers and rare earth producers?
We always have had industrial policies, so in a way, this is a continuation of industrial policies in strategic sectors. Taking shares in some of these companies is a bit novel, but I think it should be seen broadly that over the last 50 years, really since World War II, the United States government has had strategic policies and has had industrial policies. The creation of the digital economy was a public-private endeavor really from the very start. So in this sense, I think there's nothing alarming or shocking in this. What I worry about is how haphazard it is, though, right now. I don't see an overall coherence of American economic policy. None of this is well articulated or well explained or laid out in any coherent manner. And there are huge differences of helping to build up a lithium supply chain, which is a good idea, versus taking in its way this golden share in U.S. steel. This is something completely different in my view.
One thing I am curious about, though, Professor, and it's good about the context, this idea that the government, for the most part, has always been involved in this. I do wonder historically, when you look back at some of the examples where we did have some means of statecraft, if you will, how much was the government actually directing the decisions about what the company does rather than just staking the money or whatever investment up front?
It depends, but often, especially in defense-related activities, there is a tremendous amount of government engagement. And again, I think it's really important to remember, everybody knows it, that the Internet originally emerged as a Defense Department project. There was a very large role of the National Science Foundation. There was a lot of engagement with major companies. So in a sense, we deny that because we talk as if we're a free market economy. This has not been true almost ever in major strategic sectors. In oil, definitely not. In the development of the defense industry, obviously not. In the development of the semiconductor industry, the government played an enormous role. Of course, so did private entrepreneurship and innovation. But there has always been a public-private element to this. But usually there's a strategy that is clearer. Because remember, it's not only the stakes in these companies, but the tariff policy, for example, which is all over the place, absolutely inconsistent with any long-term meaningful goals. There are the cuts and attacks on the research activities of American universities. There is the outright falsehoods about the climate realities, because this is a government backed by fossil fuel industry lobbies. And that by itself, by the way, is one of the most incoherent parts of our policy. The U.S. is giving up its role and its leadership in what will be among the most important sectors of the world economy for 30 years. And it's handing it over to China, which is amazing from the point of view of what Washington claims to be America's strategic interests at this point. So I would say the policies are not unique in some sense of having an industrial policy, but I would say they're rather incoherent right now. And our government's capacity to plan, to think ahead, to be organized is extraordinarily limited, unfortunately.
I wonder with this, with these tariffs, with this policy of mass deportations, with the attack on a diversity of energy sources, how do we still continue to get 3.8% GDP growth? And this morning we got a jobless claims number that was lower than any of the forecasts that we gathered. It seems like the economy is still humming along.
Well, it's a good point you make. It's the big difference of what happens in the short term and what happens in the next 25 years. And for the next 25 years, what we're doing has some bright spots. Certainly, the AI-related advances in the United States are real, and they're significant, and they're important, and I think they'll be very productive. But much else that we're doing is very destructive of longer-term growth. So we do have a tendency in our country right now to look at today's markets or to look at a 3-month cycle. I'm trying to direct some attention to the next 25 years. And for that, that's long-term investment, that's building sectors, and that's where I'm worried.
So, Professor, though, I do want to ask you, just make a quick pivot here, and it kind of dovetails with the same conversation, the idea of the outsized influence that the White House is having right now on markets and the economy. This debate, of course, now playing out at the Federal Reserve, particularly with some of the efforts to remove Jay Powell, as well as Fed Governor Lisa Cook. And while we were speaking earlier today, we're now getting an amicus brief filed by every living former chair of the Federal Reserve talking about the potential risk to Fed independence if the Supreme Court does indeed clear a path for the president, any president for that matter, to have the unilateral ability to remove a sitting Fed governor.
Fed independence has proven its worth over several decades. This was a real innovation, and it is a very important one, and it has been taken up all over the world, the idea of central bank independence. The abuse of power generally, for instance, of one person literally declaring an emergency and then setting America's trade structure is absolutely extraordinary and very self-destructive. We've had 2 courts now that have said that the Trump administration has dramatically overreached its authority when it comes to tariff setting. Now we await the Supreme Court decision on this. Similarly, we await the Supreme Court decision on whether the president can just remove on demand a sitting Fed member. And this is all very harmful. That kind of arbitrariness is a huge threat under any circumstance.
All right, Professor, we have to leave it there. Jeffrey Sachs, Professor of International and Public Affairs over at Columbia, and of course, one of the brightest minds out there when it comes to economic development. We do just want to reiterate right now, we are keeping an eye on the Supreme Court and that fight over Lisa Cook's tenure on the Federal Reserve. Former Fed chiefs now coming to her defense. Lisa Cook also filing in her defense as well. If we could get a decision from the Supreme Court on that in a matter of days. We'll be back in a moment. From New York, this is Bloomberg. All right, cloud infrastructure company CoreWeave, and quite frankly, the darling of the AI space as of late, is expanding its partnership with OpenAI for the 3rd time to as much as $22.4 billion to help power its most advanced models. Another leap forward in the AI expansion, where just this week, we've seen NVIDIA commit $100 billion to OpenAI and Alibaba boosting that $50 billion 3-year target to even above that. Joining us right now here in Studio 2 in New York is the CEO of CoreWeave, Mike Intrator. He's joining us alongside Bloomberg Tech co-host Ed Ludlow, who's in our San Francisco bureau. Mike, great to have you here.
Great to be here.
Great partnership. Obviously, you're extending that even further. The questions, and I'm sure you've heard it frequently from investors, is when do you start to see a return on investment, or do investors start to see a return on that investment?
So the most important statistic for me to monitor as we're going through this massive build out of infrastructure is the traction that we are seeing for inference on our clusters across the board from clients, everyone from the AI native companies through the AI labs like OpenAI, all the way up through the hyperscale clouds. And what gives me confidence that there is real interest, real clients, enterprise clients consuming massive amounts of compute is the traction that we're seeing within the inference market. That is the monetization of all of the investment that's being made in artificial intelligence, and our clients cannot get enough compute in order to stand up the infrastructure to serve their paying clients what the compute that they need to use artificial intelligence in their day-to-day operations.
What changed then for OpenAI? You know, the deal was hatched in March, expanded in May, expanded again. We're talking about capacity over several years. So what changed for OpenAI that prompted them to say, you know what, Mike, we need more in this time period?
Look, there's nothing that I get excited about as much as a client that's using our infrastructure, coming back and expanding their footprint, using more compute, using more of our solution. And what's changed is that every day, more and more people are using artificial intelligence. More and more companies are integrating artificial intelligence into their workflow. And the traction that OpenAI is getting is precipitating massive investments, and they are behind on their infrastructure. They are building furiously. We are building for them furiously in order to stand up enough compute so that they can serve their clients. And that is not just true for OpenAI, it is true against or across our entire client base.
Mike, is OpenAI writing checks it can't cash? Like, how much visibility do you have that they can meet the commitments they've made to you in and amongst the tens of billions of dollars they've committed in other projects with other partners?
It's an excellent question, and I think it's really important when we think about the size of the checks that are being written to build the infrastructure, that we think about this in terms of how the financial markets are going to spread out this payment over time. And when you think about the extent to which this technology is going to change the world, is going to make the world more efficient, is going to drive massive gains within productivity, it is very, very easy to see a path to being able to support the obligations that are being undertaken in order to deliver compute for their clients. When the big clouds come to us to buy compute at massive scale, we saw a deal with one of our competitors, and Microsoft, who's a huge client of ours. Like, they're doing this because they can't deliver enough infrastructure to their paying clients who are using their services. And once again, we are seeing this phenomenon across every single sector that we serve.
So when somebody comes up to you, Mike, an investor or an analyst, and asks you about capacity constraints, what's your reaction to that?
My reaction has really not. We've been very consistent because even through the bull and bear and reactions that have been occurring in the market, the one thing that has been consistent through this entire cycle is that the buyers that come to us for infrastructure, they are coming to us and they are saying, we have clients, we have needs that we cannot serve. Help us build more infrastructure. And they are being driven by users of their product to go out and secure additional capacity, to go out and secure more efficient capacity, to go out and secure access to the infrastructure services and software that we provide.
Are you concerned at all about the concentration of your customer base right now? It's great to have Microsoft alongside. I think anybody would love that. But investors want to see, what are those downstream opportunities? How do you expand?
So when we went public, there was a lot of discussion about customer concentration. And what we have seen every single day is an increase in diversification of our client base. We are continuing to go out and bring new clients onto our infrastructure, some of them at gigantic scale, some of them are just small users. We have spent a tremendous amount of time and energy extending our software services so that we're able to pick up clients earlier in their life cycle. And I think that what you're going to see from us as a company over the next year, 2 years, is enormous diversification of our client base. Having said that, it is important to understand, and we will never get away from this right now, is that there are large users of this infrastructure. They are building foundation models. There's not going to be 4,000 foundation models.
Yeah.
Right.
The world can't afford that. It doesn't really make any sense.
Mike, if you add more OpenAI business direct, does that mean you have to give up some business with Microsoft?
So the challenge that we have is competition among our clients for the infrastructure that we have, right? It is not a question of giving up one client for another client because their demand doesn't completely absorb all of our infrastructure. It's just a question of we have 100 units of compute to deliver in the next 12 months. We could deliver all 100 to client number 1, all 100 to client number 2, or all 100 to client number 3. And the question is how are we going to divvy that up among those clients? Because, like I said, the demand for this infrastructure overwhelms the supply for the foreseeable future.
All right, Mike, really appreciate you taking time for us. That's the CEO of CoreWeave, Mike Intrator, here in Studio 2 in New York. And our thanks to Ed Ludlow, the co-host of Bloomberg Tech, which airs, of course, every day at 11 a.m., East Coast time. Meanwhile, it is 3:51 here in New York as we count you down to the closing bells. Matt, stocks down for a third straight day.
That's right. We're looking at a drop of just about 0.5% on the S&P 500 as well as the NASDAQ. Interesting that the tech-heavy index isn't falling further than the broader benchmark in percentage terms. You do see the front end of the curve popping a little bit more than the long end. So the 10-year right now up just about 2 basis points at 416, 417, and it had been closer to 420 this morning. The 2-year, however, at 365, 366. So a bigger bounce as investors maybe discount some of the cuts they had been pricing in.
All right, we count you down to the closing bells. 8 minutes until we get there. Meera Pandit joins us here in Studio 2, Executive Director and Global Market Strategist at JP Morgan Asset Management. And I can't even imagine what trying to be a strategist is like right now. I mean, are you more focused on equity market valuations? Are you more focused on where yields are going, what the Fed's going to do? What?
It's a combination of all of these factors. You can't ignore one because something odd happens with the other. So you have to think about this situation holistically. When I think about valuations right now, yes, they are expensive. And in fact, if you look at a chart, they're pretty much as expensive as they were coming out of the pandemic. However, there's some differences between now and then. We had record low interest rates back then. We had mountains of cash for consumers to power through. This time around, the consumer is more muted. This time around, we do have a higher hurdle rate when it comes to overall rates. And actually, profits have been very resilient in this environment despite some of these headwinds. So when I think about whether the market is overvalued, it's certainly highly valued, but a lot of the companies underneath the surface are producing and being resilient in face of some of these headwinds. So I don't want to worry too much about valuations quite yet, but still monitor them.
What is, though, the big risk? And you know, one of your colleagues in another division over at JP Morgan kind of quipped earlier this week that, you know, when he was talking to people about what could upend this market, it was basically an asteroid hitting the Earth. And I know it was tongue-in-cheek, but it does get to this idea that no one really seems to be worried, at least not in terms of market positioning and market pricing right now.
We've seen huge momentum in the markets and a number of all-time highs this year. And so when I look back at the history of all-time highs, and I think about when we had droughts in all-time highs, you had after the tech wreck, after the financial crisis. So let's think about valuations becoming too extended and bubbling over. Let's think about a recession and more of a systemic issue. And then 2022, 2023, when you had Fed hikes, inflation spikes. So it would really take something more meaningful when it comes to valuations and market upset or economic upset. And neither of those are out of the question. Again, valuations are very high. When we think about the economy, it is slowing. There may be some fits and starts to how that plays out over the next year.
Looked pretty fast this morning.
Yeah, it absolutely did. But most of that was really the collapse in imports. So even though the consumer looks a little bit better than it did before, it really is still a lot of noise. And as we get into next year, you might have a bit of a sugar high because people are going to get some pretty nice tax refunds. Maybe some of that AI CapEx actually accelerates because companies now have different provisions as it relates to R&D and CapEx. capex. But if that fades out in the back half of the year, then we're back to this slowing economy. And all the while, is any of that really going to help the labor market? If the labor market is showing some signs of weakness and we're in this tenuous equilibrium between weak demand and weak supply, we can't exist in that tenuous equilibrium indefinitely.
I can't understand why everyone is so down on the labor market, considering the fact that the pool is shrinking, right? We're looking at a mass deportation policy. Nobody else is allowed in. If you want to hire, you don't have many people to choose from right now. So shouldn't that boost, the price for that labor?
It can, again, exist in this equilibrium for a period of time where demand is weak, but supply, due to things like immigration, also aging population, increasing retirements, offsets that. The question is, how long can you exist in that environment? And is the job creation, stable rate of that job creation that low? Is it as low as 30,000 jobs a month, which is we've been seeing? So I think that we want to think about where the economy is going, not where it is today. So we have to be mindful of all of these different risks. That doesn't mean that should stop us or paralyze us from investing today, because your bonds have done amazingly well, your stocks have done amazingly well. So you don't want to lose sight of that either.
I just want to point out, we've got the latest Investment Company Institute data on money market funds, another record high. When does that stop? I mean, is it just everyone's just basically sitting on those yields? Or is there something?
Take a look at the slope. I mean, it's over $7 trillion, but it's really accelerated in the past couple of years. We were talking with Stephen Lately about this from Blackrock yesterday.
Look, certainly there's the reinvestment risk that we're going to start to see as the Fed cuts. So we do want to be mindful that people may not want to park as much money in cash, but that's going to be a core holding that people have. But we have to consider what's going on in the equity markets, what's going on in the fixed income markets, where you might get some better yield. Even from a risk-adjusted perspective, it's not looking so dire in that situation. But also within the equity market, you have a lot of interesting things going on underneath the surface. I know a lot of attention is still being paid to the Mag 7, but if you look at the best 50 performing stocks year to date, 10 of the 11 S&P 500 sectors are represented. If you extended that to 51 stocks, all S&P 500 sectors would be represented. It's about 50-50 value growth, and not one Mag 7 is in those best 50 performing stocks. The biggest is not always the best. The biggest spenders are not always going to have that immediate return on their investment. So certainly a lot of that market valuation and market cap has gone up. But when we think about our portfolios, we do have to be grateful of the amount of choice that we have this year, not only in the U.S., but also extending that bucket to international as well.
All right, Meera, I have to leave it there. Always a great conversation. Meera Pandit, Executive Director and Global Market Strategist at J.P. Morgan Asset Management. A third day where we've seen a bit of a pullback in markets as people, I guess, try to assess not just valuations, but really right now, Matt, I think the guessing game over where rates go next.
Yeah, absolutely. I mean, before this GDP data, before this weekly jobless claims number came in at such a low level, you would have thought Stephen Myron could win a couple more governors over to his side of the dissent, that maybe 50 needs to be one of the cuts in the next couple of meetings. Yeah,
next month's meeting is definitely going to be an interesting one if the economic data continues on this trend line. A full breakdown of all of today's market action starts now.
The Closing Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close, starts right now.
And right now, we are 2 minutes away from the end of the trading day. Romaine Bostick alongside Matt Miller, taking you through to that closing bell with a global simulcast. We're joined now by Carol Massar and Tim Stenovic in the radio booth. Welcome to our audiences across all of our Bloomberg platforms. Carol Massar on another down day for the markets, fractional losses to be sure. But when you kind of stack it up over the last few days, a lot more caution coming back into this market.
Yeah, I was just reading a headline off one of our global markets wrap stories, and it talked about the S&P 500 on track for its longest losing streak in a month. Keep in mind, there was a period where it felt like we had record after record after record. We've seen quite a run up. So maybe investors, guys, just waiting for the next round of earnings or more clarity from Fed speakers about what comes next with the U.S. Central Bank.
We'll get a little clarity tomorrow, maybe an idea of what the Fed will do, because we'll get core PCE price index tomorrow. We know that's what the Fed wants to see. I don't know, though. What else is going to, before we get earnings, and we're going to, we'll get Costco today and we'll get Jeffries later this week. And, we'll get JP Morgan in a couple weeks. Before that, I'm trying to find out what the catalyst is going to be.
By the way, Costco is one of my favorite stocks to look at. And the reason is that the estimated PE is so much higher than that of NVIDIA, right? We're looking at a forward PE of 52 on Costco. And if you look at NVIDIA, which is, the darling of this multi-year rally that we've seen, the forward PE there is only less than 40. So it'll be interesting to see what they come out on, with an E on that ratio.
Yeah, I went into a Costco once.
I go in there every week.
Yeah. All right, we get red across the screen here for yet another day with the majority of stocks in each of the indices in the red. The Dow down about 0.4%. The S&P now back down to that 6,600 level. It takes a while for these numbers to settle, but it looks like 6,605 is right around where we're going to end up. Down 33 points or 0.5 percentage point lower on the day. The NASDAQ Composite and NASDAQ 100 down by a similar amount, but the big laggard on the day, that remains the Russell 2000, down by about 24 points or 1% even.
All right, guys, back to the S&P 500 I go, and you've got most names in the index lower on this Thursday. You're talking about 383 to the downside, 119 to the upside, Matt, and one unchanged.
Yeah, one winner for every 4 losers, essentially. It's even worse if you look at the breadth of industry groups. IT was a gainer today because you have that Intel Apple story, which I still find so fascinating. You can do this the hard way or you can do this the easy way, right?
I don't think that's the same story.
Maybe Apple takes a stake in Intel. It may make a lot of other things easier for them.
We are calling it CEO diplomacy.
Yeah, so you see IT and really energy kind of flat, but they are the only green slices of the pie.
But on that point, I mean, I heard your interview a little bit earlier today, Carol and Tim, with Mark Gurman, who, of course, covers all things Apple. And you kind of put him on the spot there with some of the questions about Tim Cook. But I thought he kind of made a good point. I mean, look, there is a fiduciary duty that any CEO has to its investors and, for that matter, to its employees and its customers. And he's navigating that, as he should do. Right?
Yeah,
or he shouldn't be CEO.
I agree. We keep talking about that, right? If you don't really want to get on the radar of the White House or the administration, and you've got to think about your company and you got to think about the financials or your share price, I mean, right, there is a responsibility, but it's just kind of interesting to see how.
Well, you got to want to diversify too, right? You can't make all of your chips at TSMC all of the time. Why not get another foundry?
But they've moved away from Intel in the past, and Mark made the point. Of course,
they design them all in-house, but where they design them and where they make them are two very different things.
Mark made the point, like, maybe they could make some of the, some of the chips that they use in some of the devices. There are so many, but that's not what this is about.
Either way, I'm going to say, if you're an Intel shareholder right now, you're pretty happy because you continue to see this stock moving up.
They're up 9% today, Carol.
Yeah, I know.
Are you going to get to your gainers eventually?
Yeah, well, that was my segue. Thanks for jumping in on it again.
9%, Matt.
All right, where is Katie, the boys? Intel up almost 9% in today's session. It is the top gainer in both the S&P 500, the NASDAQ 100. It was also upgraded to neutral from sell over at Seaport Global. They see near-term upside for the chip maker if it receives more direct investments. There you have it. That's pretty clear going forward. And of course, we've been talking about the Apple Intel, whether or not we get something out of that. Lithium Americas, guys, also an outperformer in a big way, up about 23% after almost a 96% gain yesterday. Heavy volume in today's trading today. White House proposed taking equity in the company during a renegotiation of some terms of a $2.3 billion loan extended by the Energy Department. Bloomberg News reporting that out. That came out on Tuesday. We've had Reuters reporting that the administration was seeking a stake of as much as 10%. Nonetheless, it's on everybody's radar. We are living in a very different capitalistic environment, it feels like, certainly with the government potentially taking stakes in various companies. All right, Synopsys, got to bring that one out, guys, because that too was a top gainer in both the S&P 500, NASDAQ 100, up about 4% here. Some reporting the company out with a release that it and Taiwan Semi have been working together to shorten design cycle times on more efficient chip technology. So that caught the attention. So some good gainers there.
Well, what caught my attention was some of the decliners in the S&P 500. The worst performer on a percentage basis in there was CarMax by a long shot, down 20% today. Shares tumbled after the company reported weaker than expected results. It showed deepening strain in the used car market. Company executives actually came out and said fallout from President Trump's tariffs and rising distress among consumers were what led to falling sales and profit. There have been some recent challenges in the auto industry, as Matt is absolutely aware. Subprime auto lender Tricolor Holdings declared bankruptcy this month amid allegations of fraud. First Brands Group is preparing to file bankruptcy as soon as next week, Bloomberg News reported. Once again, shares down 20%, the worst performer in the S&P 500. Tesla, speaking of automakers, down 4.4%. It was the worst performer of the Mag 7 today on a percentage basis. Shares fell as European sales of Teslas fell 22% last month, giving a market share of just 1.9%. European car sales overall climbed 4.7% last month. It turns out that EV sales actually rose in the region last month. Hybrids, though, were a particularly bright spot.
By the way, that bears repeating. That bears repeating. So European car sales rose 5%.
Yes.
EV sales in Europe rose.
And Tesla fell
22%.
Yeah. Seems like a Tesla, a challenge particular to Tesla then. And that's why you had shares fall today, probably. Finally, Freeport-McMoRan, among the worst performers in the S&P 500 as well, fell another 6%, down 6.2% today. Fallout from the accident at the Grasberg copper mine in Indonesia continues. The accident at the mine killed 2 workers that left 5 missing, and it's led Freeport to declare force majeure on contracted supplies and slash its production guidance. We spoke to Joe Doe, who covers economic statecraft, and he's for years has covered metals and mining. And he talked to us a little bit about the negotiations between the Indonesian government, which controls 51% of the local entity, and now the concern that the government might want more of that mine ownership and what that could mean.
All right, a quick check on yields here. Up for a second straight day, up for the third time in the last 4 sessions. And a big part of the reason is that stronger economic data that now seems to be throwing just a touch of cold water here on the idea of whether the Fed actually does have the room to continue cutting rates beyond that first 25 basis points that we already got. I do want to go back to the stock market, though, and some of the individual movers. One of the decliners you didn't have on your board there, Tim Stenovic.
Oh, wow,
Starbucks.
You're targeting Tim
Yeah,
this
well, I knew we were
time.
talking about this, so I didn't want to do it as one of the decliners.
Good programming.
Sometimes you got to think about this stuff.
That was a segue
down
for you, Carol Master. You still haven't picked up.
It was also barely down today. Yeah. It's down like half a percentage point, too. So
is she going to talk about something?
She's going to talk about
it. Isn't that your story?
She's trying to get a word in, but
you know what?
We're not letting her. Go ahead, Carol.
Let's talk about Starbucks. I was going to put this in the category of meh. I mean, you have Starbucks closing, 1% of its stores in the United States and Canada, cutting 900 jobs. It's all part of its turnaround plan. And investors, not that impressed. The stock's down. It was up about 0.5% at its best levels of the session today, finishing with about a decline of about 0.5%.
You try to tee people up, Matt Miller, and sometimes they just don't. I don't know if you have this problem. You host a show yourself.
Yeah,
so you have to do this.
I think it's an exciting story, regardless of the share move. Because look, they're firing 900 workers. They're closing only 1% of 18,000 stores.
Yeah.
But a lot of people have been coming out this morning and saying this is the right track, and maybe this is what they needed to do from the start, right? Brian Nichols been in office for over a year, and since then the stock has fallen 6%. Why didn't he do this earlier? Why didn't he maybe cut a little bit deeper? They just have too many stores, and they're not as exciting as they used to be.
But to that point,
they need to spruce it up.
Is 1% and 900 workers going to do anything? And look, I know these are corporate workers, and every job lost is terrible, but 360,000 employees is what the company has globally. So this is a small figure when you think about those numbers.
That's precisely my point.
Well, maybe as some of the analysts said, that their prices are maybe just too high, and people maybe they have to address that.
Yeah, I mean, isn't Tim like the $75 bag of coffee guy?
Yeah, but it's a 5-pound bag of coffee.
You keep telling me that.
It takes a long time to go through 5 pounds.
Isn't that where the pound cake comes from?
No, I get the pound cake that you and I enjoy so much from LA Gourmet on 58th and Park.
So good.
Is there pound cake that's being shared amongst you two, but not the other?
Wow.
Not for the last couple weeks, though. I've lost 10 pounds.
I know, which I actually appreciate too. You look good.
Thank you.
Yeah. If you're really nice to him, Romaine, maybe you'll get some.
Okay. All right.
But
All right, we are like 2 minutes over, so say goodbye.
That's a wrap. Our cross-platform coverage, radio, TV, YouTube, Bloomberg Originals. We just didn't want to leave you guys. Romaine and Matt continuing over there on television on the close, and Tim and I continuing on Bloomberg Business Week Daily.
Stick with us. We'll be back in a moment here on the close with Tom Becker over at Blackrock. This is Bloomberg.
The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
Welcome back to the close, the third straight day of declines for all of the major indices, the S&P, the Dow, the Russell, and the NASDAQ. Today's downdraft tied to actually relatively good economic data, but economic data that maybe throws cold water on the idea that interest rates will come down. Higher for a second day on the 10-year yield, higher for a second day on the 2-year as well. And keep an eye on the VIX, actually setting up to do something that it hasn't done since February, and that's actually move higher for 2 consecutive weeks. A bit of caution coming back into this market, partly because of the macro, but also because of the micro. CarMax really sort of the mashup of those two worlds. Some disappointing issues with regards to sales and volume moving out there. A big drop, one of the biggest drops in the S&P today, down 20%. Accenture also moving lower. They actually raised the alarm on IT spending by the federal government, saying that that could actually be cut going into 2026. Some concerns there that not only drag Accenture down, but other companies in that space like Booz Allen Hamilton, MicroStrategy, and the rest of the crypto sphere also on the back foot. This has to do with that big options expiry coming up in about a week's time, but still some bright spots out there in the tech space, including from some old school tech like IBM, as the AI race continues to broaden out, at least for some names out there. And that brings us to our top story, and the fact that despite some of the losses that we've seen over the past 3 sessions, the S&P is actually still on track for its best September, going back to at least 2013. The price levels are high and market positioning is still narrow, and we've talked a lot about that over the past few days. The overwhelmingly bullish tilt to market sentiment. And it's a tilt that today was both reinforced and rebuked by that strong economic data that looks supportive of corporate fundamentals, but less supportive for the multiple interest rate cuts that investors have been betting on. This is all raising the risk of widening price swings should the market receive a shock, like a material miss in corporate earnings or a meaningful shift in the economic picture or the heightening of global tensions, as, of course, European leaders keeping their eye in the sky for their incursion by Russian jets. We're going to have that conversation in just a bit. But our next guest, who helps oversee BlackRock's tactical asset allocations, says his folks, they've actually taken down directional equity longs over the past 2 months. Tom Becker joins us right now, senior macro portfolio manager at BlackRock. All right, Tom, let's talk a little bit about how much you've taken that down. That's not necessarily a bearish call, but just a little bit of an adjustment. And I am curious as to why.
Yeah, that's right, Romaine. Good to see you again. I think you've got to juxtapose where we are now in the cycle versus where we were in the summer. There were concerns about a recession in the summer. These revisions today in the GDP data point to actually closer to an overheated economy rather than kind of a stall speed economy or certainly a slowing economy. So I think a lot of that good news has been priced by equities. Equities kind of got ahead of the revisions. They sort of are sitting in a position here where they've sort of seen that the corporate earnings outlook is pretty strong. And then I think more recently, they've been responding a little bit more to the dovish pivot from policymakers. And in particular, kind of, the insurance view of how to deal with the revisions to the labor market. But when you look at growth, when you look at inflation, when you look at kind of the nominal economy, we had a 6% quarter in Q2.
Yeah.
Equities price a lot of that.
Well, I am curious, though, particularly when it comes to the labor market. We've been hearing from a lot of Fed officials today. So far, most of them, including Jay Powell, seem to have said that right now their focus is much more on making sure that the labor market is sound. Almost to the point, and they're not saying this explicitly, but almost to the point at the expense, at least in the short term, of any inflationary pressures. Is the market also pricing in that general sentiment?
I'd say the market was pricing that in until these more recent speeches by some of the regional presidents. I think kind of the emphasis on insurance and this sense that the revisions to the run rate of payrolls and job creation was the catalyst for the cut. As we get more good data from here, I think there is a real risk, like you were just saying, that good news equals bad news for financial assets. And part of that is because real interest rates, kind of the real rates have fallen a lot over the course of the year and over the last 2 months. And so if you just get some reversion of the real price of money in the economy, I think that's going to be tough for both stocks and bonds, given how much they've already priced.
There's also this idea of sort of expectations already being high. We were having this conversation on the program after Micron's earnings a few days ago, which were great, and more, I should say, the guidance was great. But we saw the sell-off in the stock primarily because that was already kind of priced in, as you said. And I do wonder, is there any sort of upside price scenario that you actually see? Anything that could surprise folks in a way that would sort of give them conviction that you put more into this market rather than simply taking your profits or just simply riding this out?
Good question. I think actually today's GDP data and specifically the GDI revisions actually have us a little bit more cautious about the earnings outlook. Pretty big revision to kind of the trajectory of earnings across the whole economy. So we got a lot of information the last couple of months about Q2 earnings for the publicly listed companies. But with this holistic data across the whole economy, it looks like a lot of the tariff pain is being borne by non-listed smaller companies, kind of consistent with what you were talking about earlier with some of these, car and industry and lenders feeling the pain. We're seeing that now in some of the quarterly BLS data. So to us, that speaks to kind of an earnings trajectory that might not be as kind of bulletproof as we might have thought just a couple weeks ago. And then you've got this risk of kind of the overall economy doing well with inflation, drifting higher still. I think that's an economy where kind of overall valuations are fully priced.
We only have time for one more question, Tom, but I do just want to ask you about kind of what's going on in the fixed income space, particularly when it comes to the competition between sovereign assets. Obviously, the U.S. is still king and probably will continue to be king, but you have seen an allocation outside of the U.S., or more of an allocation, I should say, outside of the U.S. Are you seeing the same?
I think over the last couple of months, you've seen an outperformance of U.S. Treasuries versus rest of world. And that's been on the back of kind of the labor market concerns and kind of the Fed's response to that. Over the last few weeks, we've been shifting more allocations into ex-U.S. fixed income, particularly in Europe. European inflation is below target. And some of the resilience in that economy, some of the fiscal kind of thrusts that we were hoping for and positioning for, looks like it might not be feeding in as much. Whereas in the U.S., the recent data looks like it's going from strength to strength. That makes us want to source duration outside the U.S., and we've been selling treasuries versus German bonds and other foreign government markets.
All right, Tom, great stuff as always. Tom Becker, one of the best in the business, senior macro portfolio manager over at Blackrock, who oversees a lot of their tactical strategies. Do want to bring you some breaking news on earnings, this involving Costco, the company out with its fiscal fourth quarter results relatively in line across the board for the company, both on the revenue side and on the bottom line. Overall, when we talk about that comp sales growth number, seeing ex-gas up 6.4%. The street was looking for 6.21%, a modest move in the shares higher here in the after-hours trade. Meanwhile, we do have our eyes on Washington, where we are awaiting President Trump to actually sign an order to seal that TikTok deal. We're going to talk about what it means, particularly on the security side. Ivan Tsarynny, CEO and co-founder of the cybersecurity firm Feroot, going to be joining us in a second. This is The Close on Bloomberg. Well, the future of TikTok still hanging in the balance. We are awaiting the potential for President Trump to sign an executive order that would finally seal the deal on where those U.S. assets go. Various news reports say that Oracle will lead a consortium of investors alongside Silver Lake and Abu Dhabi-based investment company MGX to invest in the U.S. version of the app. But there are still some big questions about what that app looks like on the back end, particularly when it comes to security. Ivan Tsarynny is the CEO and co-founder of the cybersecurity firm Feroot. And Ivan, it's always a reminder, this whole TikTok mess kind of started ostensibly because of concerns about security issues and the apps and algorithms ties to the Chinese government. Based on what we think we know about this potential sale of U.S. assets, does that resolve those concerns?
Yes, thanks for asking. That's a really important question. So first of all, it will definitely move it forward in terms of resolving these concerns. And to remind, what are the concerns? Besides, obviously, the sale of the company, the number one concern is who will regain and retain the access to the data. So there are a couple of swimming lanes there. One of them is the people. Will the new company be able to control the people and make sure that only the vetted people will be able to access the Americans' data? And number two, who will have the access to the algorithm? What kind of data will be collected after the transaction?
So when we assuming we get the details and based on the reporting, assuming that those details are true, I am curious just about the whole idea of this investment consortium, because it's a little bit broader than I think what some people had thought. Originally, it seemed like it was going to be maybe one or two big companies, U.S. companies, I should say, would have the control. But it does look like that there are other investors, non-U.S. investors, that would also be a part of this. Is that complicated?
Well, the devil is in the details. What really is going to matter after the transaction is completed is, again, who will be the controlling body. So in an ideal world, only the Americans will have the control of the governance of the new company. And only the Americans will be able to control who has the data, and ensuring and also preventing Americans' data from leaving the borders and going into the Chinese hands. And one of the reasons it's very important is obviously we're in the AI race, and that AI models, the Chinese models, especially when they're being trained on real-time, up-to-date, up to the minute, up to the second accurate Americans' data, that can give them an advantage, especially when they know what you're reading, what you're doing, what you're clicking on, what you're watching. So it is really important that the new consortium, whatever it's going to be like, retains and gains full control.
I just want to point out to our viewers, if you look there at the bottom of your screen, you are taking a view right now of President Trump in the Oval Office signing an executive order. This one right now is on Turkey and some meetings that Trump had earlier today on Erdogan. We are keeping an eye on those comments, and we'll bring you any breaking news out of that. But of course, we're also expecting potentially an announcement on that TikTok deal. And Ivan, and I should point out, Trump now saying that President Xi, according to President Trump, that President Xi of China has given them the go-ahead to move on TikTok. Ivan, as we sort of await more details as to exactly what this is going to look like, there's also the idea that this is basically going to be a new app, and I would assume a whole new batch of employees to go along with it.
Yes, and hopefully it will be obviously the new batch of employees, especially the ones that have governance and control over the new app, but is going to be still called the TikTok or any other name. It is really important, like you're saying, if it's a new set of employees, to make sure that nobody is under the control or jurisdiction of China. So nobody's going to be, having ability to build in a backdoor to Americans' data. Because there have been concerns that, if somebody doesn't do what CCP wants them to do, their kids might be sent to a re-education camp, which is not a fun camp.
Hey, Ivan, hold that thought for 1 second. We just want to go down to the White House and take a listen. He is signing that executive order right now on TikTok.
Said to me, you should go on TikTok. And it actually had, because we got record votes with the young voter, as you know, for the election. So I was a little bit prejudiced in that way toward TikTok. It was very good and very meaningful. But we have American investors taking it over, running it, highly sophisticated, including Larry Ellison. And Oracle, I guess, is going to play a very big role in terms of security, safety, and everything else. So we have very good controls. And literally, I would get a call from friends of mine who were fathers of young people saying, could you do me a favor? Could you get it approved, please? My son is driving me crazy. So we're getting it done, and they have a big audience. And we have great American investors. And here's your final copy. TikTok. Maybe if you want, we could take a couple of questions on TikTok, and then we're going to get onto something completely different. Okay? Yeah.
Mr. President,
Jeff?
Mr. Vice President, you mentioned that China was resistant. Can you describe where China is now? Are they fully on board with this?
They're on board. Yeah. I spoke with President Xi. We had a good talk. I told him what we were doing, and he said, go ahead with it.
On the algorithm, it's still being leased coming from China. Are you satisfied that there's no security concerns? For
I am. I really am.
It would push disruptive
content. The biggest reason is that it's owned by Americans, and very sophisticated Americans, and people that love the country, and very smart Americans too. So they don't want anything like that to happen. Yes, please.
Thank you. Is there any operational relationship with Chinese entities or staff to execute the deal?
With who?
With the Chinese.
I don't think so. Not that I know. No, this is going to be American operated all the way. And great respect for President Xi, and I very much appreciate that he approved the deal, because to get it done properly, we really needed the support of China and the approval of China. Yes, ma'am.
Mr. President, now that Americans will have operational control, do you want to see the algorithm suggest more MAGA-related content prioritized?
I always like MAGA-related. If I could, I'd make it 100% MAGA-related. It's actually a good question, but I would, yeah, if I could make it 100% MAGA, I would, but it's not going to work out that way, unfortunately. No, everyone's going to be treated fairly. Every group, every philosophy, every policy will be treated very fairly. Thank you.
Mr. President, do you know the valuation? Do you know the American company is going to be valued in the billions?
Well, they valued it very highly. They're paying a big number. Do you want to talk, Scott? Do you want to say something about value?
Well, I'll let the Vice President, and then I can follow up.
And you'll say something.
Sure. Well, first of all, I would say all credit goes to the Secretary of the Treasury. Couldn't have got it done without Scott. Also couldn't have got it done without Sean Cooksey on my team, so thanks to them. The company will be valued around $14 billion. We actually think this is a good deal for investors, but ultimately the investors are going to make the determination about what they want to invest in and what they think is a proper value. The most important thing is that it does protect Americans' data security. It ensures TikTok is still accessible. And on this question of the algorithm, which we've heard this a lot, what this deal ensures is that the American entity and the American investors will actually control the algorithm. We don't want this used as a propaganda tool by any foreign government. We want to make sure that our people and our investors actually make these decisions based on what's good for their business as opposed to what's good for another government's propaganda arm. So that's what we've done with this deal. I think it's very good for the American people. And as the president said, young people love this. We actually want everybody to access this, whether they're MAGA or not. We just want it to be fair. We want it to be fair to everybody. And we think that's what's going to happen with this new arrangement.
Well, the U.S. government. And just to follow up on the Vice President, there were two pieces to the transaction. The Vice President's office.
Right now, we are listening to the Treasury Secretary of the United States, Scott Bessent, speaking alongside J.D. Vance, the Vice President, as well as the President of the United States, Donald Trump, signing an executive order that effectively seals that deal to sell the U.S. Assets of TikTok back to the United States here. We should point out the president did say that China was on board with this deal. J.D. Vance actually addressing the valuation of the company, saying that it would be a $14 billion valuation and that this deal would protect Americans' security. I want to bring Ivan Tsarynny back into the conversation, CEO and co-founder of the cybersecurity firm Feroot, because one thing that the president was asked and did address was this idea of the algorithm still being leased from China and whether that posed any real security issues. The president says it doesn't, Ivan.
Yes, that's a really important and an excellent question. I think just like the President Trump and Vice President mentioned, it will be run by sophisticated American investors and sophisticated, very, very smart people. So very likely that algorithm and data security concerns will be addressed very quickly.
Ivan, really appreciate your time. Ivan Tsarynny, CEO and co-founder of cybersecurity firm Feroot. And you can continue watching the president's event there in the Oval Office by typing live go on the Bloomberg terminal. He signed a couple of executive orders, one regarding on Turkey and right now discussing the deal for TikTok. We do want to stay, I guess, in the creator space and more importantly, in the shopping space, particularly with the latest data showing that the U.S. economy growing at the fastest rate in nearly 2 years. The catalyst at the center of it all is consumer spending, again, defying persistent inflation and weathering early stage tariff pressures. A company with some key insights into exactly what the consumer is doing and where they're going is Klaviyo. It combines marketing, automation, analytics, and customer service into one big solution. And I'm pleased to say that the CEO joins us right now here on the big program, Andrew Bialecki, the CEO over at Klaviyo. Andrew, great to have you here on the program. Obviously, a lot of focus on you, not just because of what we've seen in the past, but of course, the holiday shopping season, at least for a lot of us, is pretty much already here. What are you seeing?
Yeah, so we're seeing a lot of businesses preparing for the holidays, and a lot of that is probably no surprise, doing it with AI. So we're here at our conference today. We launched a bunch of new AI features, a marketing agent to help businesses, generate a marketing strategy. Let's say for Black Friday, Cyber Monday, generate all the content and creative, as well as another thing we're seeing is consumers are turning more to businesses and their AIs to help guide them in their shopping. So we also launched a customer agent. You can think of it as a personal concierge, personal assistant that's always on the website. Maybe if you need some gifting advice on what to buy, for that person that you're shopping for, AI can help you do that too.
I am curious about the effectiveness of this. I mean, we've heard from other companies that have employed some of these AI or AI adjacent technology tools. Do you have a sense, though, of how effective they are in that actually translating to a sale?
Yeah, on both fronts. So on the marketing side, for instance, one of the things we did today is launched a marketing agent that will do two things. One, it'll look through all of your past marketing, identify which campaigns and messages resonated, so you can double down on those, and also to which customers, you can do more personalization. We also launched, as part of that, a content agent, that's part of our marketing agent, that will basically take a business, like for instance, our friends at Away Travel were here today. And so maybe if you're, wanting to show somebody what's the right suitcase, you can also teach them a little bit like how to pack that suitcase, or what's the right size suitcase if you're going on a big European trip. So on the marketing side, marketing is getting smarter, it's converting better, and businesses love that. And then on the consumer side, obviously people expect more, both from the the GPTs that they're using, but also now they're expecting customers to provide that. And the better those agents are, the more consumers are spending.
I mean, forgive me, this might be a loaded question, and maybe it's just kind of a reflection of being from an older generation, but have you had any issues with people that maybe bristle at the idea of being guided by the technology rather than the human salesperson that was kind of the hallmark of the past?
I think we're going through, this kind of the valley where, chatbots and AI weren't good enough. You'd ask it a question, it would kind of spit back, gibberish or a partial answer. The models are now good enough that I think we're seeing a lot of consumers say that if the answer is correct, and the fact that it's faster, there's no hold time, there's no wait time, it can answer a wider variety of questions. It's like your best, salesperson or customer service rep, all rolled into one. If it provides that, consumers are shopping more. And just an example, we're seeing things like recommendations, not just customer service use cases, but actually advice on what to buy are becoming very, very popular queries, with those customer agents and chatbots.
We showed a few of Klaviyo's customers, and I am curious about just the differentiation. I mean, I would assume that the experience that Mattel has is going to be different from another customer set there. How do you make sure that as you're rolling out these tools, that they are indeed unique, not just to the individual companies, but the individual consumers for each of those products?
Yeah, that's one of the things that's really important to brands is they want to infuse these agents with their own personality. And when you use these general agents, they obviously just have this kind of generalist personality. So instead with Klaviyo, what you can do is you can obviously teach it about your brand. So you can upload, like, say, guidelines. We also have a little bit of a AI researcher that will go off and look at your brand across your website, social media, kind of distill that down. And then we have a bunch of brand safety and quality checks that will make sure that the responses you're getting, both, say from a customer agent when it's chatting or your marketing creative, it's actually on tone for that business. That's actually, the quality there is so good in terms of checking the AI results. Our customers are actually asking us to put those same checks in front of the human-generated content, because it's a good way to teach people that are maybe new to the marketing team or new to the customer service team about what that brand actually stands for.
Andrew, I am curious, as we kind of head into this holiday season, are you seeing a meaningful difference in the way that some of the retailers are approaching this season vis-a-vis what we saw over the last couple of years?
Yeah, well, one persistent theme we've seen in the last couple of years, I think retailers are diving into, is this idea that when you go back to customers who are loyal to your business, who maybe are past consumers, they're less discount sensitive. So when there's maybe a little bit more pressure on margins, we see a lot of businesses that are going back to existing customers. They're spending more time, more effort on personalizing that experience, matching the right each consumer up with the right product. And because of that, they're recognizing they don't have to do as much discounting. So they're still doing some, but they realize that will help relieve some of that margin pressure.
Andrew, really appreciate you taking time for us. Andrew Bialecki there, the CEO over at Klaviyo. A closer look right now at the health of the consumer as we check in on the markets, which pulled back a bit on this day, partly because of the health of the economy. The idea that rate cuts might not necessarily be warranted with that upgrade in second quarter GDP numbers and monthly data on business inventories, as well as jobless claims that seem to suggest the economy holding up a little bit stronger than expected. When we come back after the break, we're going to continue this conversation about the health of the consumer with the co-founder of State Bags. Stick with us. This is The Close on Bloomberg. We continue to focus on the consumer, and we are expecting some more color on that. From the University of Michigan, its sentiment survey, that's coming out tomorrow. Consumer spending, it's been resilient so far, helping the U.S. economy in the second quarter power well above expectations. We want to get some insights into another pocket of that space and bring in Jack Tatelman, CEO and co-founder of the accessories brand State Bags, which actually has its roots in helping under-resourced kids. Jack, great to have you here.
Thank you for having me
Actually,
here.
let's just start with that last one, because for those folks who aren't familiar with your bags, this kind of came out of a nonprofit initiative that you and your husband were involved with. Explain that.
So my husband and I started a nonprofit summer camp about 15 years ago for kids from Brooklyn. And the first couple of summers, they were coming to camp with their stuff in trash bags or ripped bags. We knew that that's how they were bringing all of their things for a week away from home. And so that's when we decided to start State as a true one-for-one, a backpack brand, where for every backpack we sold, we donate to American kids living in situations of need. But we have since evolved. We are a full-fledged family lifestyle bag brand with luggage and toiletry kits and fanny packs. And we donate to American kids and families in need in the ways they need it most.
I've seen how wide the array of products is on your website relative to what it was maybe just, I don't know, a couple years ago. I am curious, I mean, this is a crowded space. I mean, you know, anyone who walks into a department store, goes online, you know, everyone's making bags. How do you stand out?
Well, I think that we are doing it different than everybody. Our kids' product is outrageous. Each bag is like a work of art. We really like to infuse fashion and fun with function and quality, and I think that that's the reason why people keep coming back to us. And we serve the whole family, so once we're a trusted brand in the home, they keep bringing us back in.
With regards to your designs, is that just your own creative mind, or are you doing market research trying to figure out what kids and parents would sort of gravitate to?
We're doing all of it. I have a great design team, but we're looking at the runways, we're looking at market research, we're doing all sorts of things because it's super important for us to stand out.
Where are you sourcing your materials from?
We are producing in Vietnam, Philippines, and a little bit in Cambodia.
Have you had any real material hit yet from the increase in tariffs?
Well, yes, in the beginning it was very tumultuous for us bringing in our back-to-school product because we did have some of our high novelty coming in from China, and that was really hard for us to be able to plan efficiently, not really knowing what was going to happen.
Was that sort of like, you know, it was in transit and you found out you were going to have to pay a lot more, or was it in the ordering process of what you needed and then you were able to maybe just adjust financially on
it? It was loaded on the boats.
It was?
Yes, so we had to, we delayed as long as we could just to understand what was going to happen, but then we just had to let it sail.
Where do things look like right now in terms of your clarity on where tariffs are going to be and how you're going to be able to manage them?
I mean, I don't have exact clarity. I wish I did. We did move our product out of China, which we think is going to be really helpful for us. But, you know, it's really hard to plan right now. It's a very tumultuous time, and we're doing the very best that we can and planning, you know, as best we can.
What type of pricing power do you have if you do need to raise prices?
Well, we did raise prices already, and we haven't seen any resistance. I really don't want to raise prices anymore, but I do think that there is a little bit of wiggle room just because everything is getting more expensive. So I think the customer is sort of used to seeing that price increase across the board.
Most of your sales are direct to consumer. People are coming to you to actually get that. You do have some retail partnerships, though, as well, correct?
We do.
Have you had any sort of pushback from some of those retail partners on pricing?
No, not yet. Again, I think everything is just getting more expensive, and so it's just par for the course right now.
What does expansion look like for you? Is it just more products, or is it entering new markets? What?
Well, I mean, I think we barely scratched the surface with what we're capable of. We have a lot of new collaborations coming out in 2026, which are going to be unbelievable and definitely change the face of the business, as well as some different kind of new arms of some of the categories that we already are running.
When you say collaborations, like with other brands or some big celebrities or something like that?
With brands, with other brands.
With other brands.
Yes.
You should call the Kardashians. You know, they have a lot of influence.
Do you know them? I would love to hook me up.
I don't. They won't return my calls either. In all seriousness, though, it also gets to this idea that as you expand as a brand, the idea of staying fresh and staying relevant. And we've seen in fashion, and I guess we could kind of put this in the fashion category to a certain extent.
Yes, absolutely.
Here. How do you adjust to how quickly those trends can change?
I mean, I think that it's important for us to stay in our lane and to really just kind of put out there what we love and what we think is really interesting for the customer and not focus that much on trends. Our adult product is relatively simple and easy to wear, so we do put out new great colors, and that really falls into the great trend category, but everything else is just us kind of doing what we love and putting together beautiful pieces of art.
Yeah. Have you had to raise money? Are you looking to raise money from external sources?
We will be looking to raise money soon.
Okay, well, when you do, I hope you come back and talk to us.
Thank you so much.
All right, great to meet you, Jack. Jack Tatelman there, the CEO and co-founder of the accessories brand State Bags. All right, we continue to watch quite a few stories going on out there. Of course, a lot of concerns right now about what's been happening down at the Federal Reserve Building, and particularly with the status of Fed Governor Lisa Cook. Earlier today, attorneys for Lisa Cook urged the Supreme Court to let her stay on the job while she fights President Trump's attempt to fire her. Also, we're keeping an eye on an amicus brief where every living former Fed chief out there basically saying that removing her would be a blow to Fed independence. Our very own economics editor, Michael McKee, joins us now from Washington to talk a little bit more about this. Mike, where do we stand in this case? What are we waiting for right now?
Well, we're now waiting for the Supreme Court's decision because they set a deadline of 4 p.m. this afternoon for briefs to be filed, and Lisa Cook has filed, along with those additional amicus briefs. So now it's up to the court to make a decision. In the past, they have moved fairly quickly on these Trump firing officials cases, sometimes within a day. So a decision could come at any time. The question is, where do they go from here? Do they say that she keeps her job by turning down the president's request for a stay and send it back to the lower courts because it hasn't gone through that yet? Or do they say that the president, for one reason or another, argued by the administration, can let her go in the meantime and then let it go through the lower court? So those are the decisions that we're waiting on right now.
I am curious, Mike, just in your reporting and talking to folks about the potential of what could happen. This brief, specifically in their words, says, quote, her removal risks, quote, chaos and disruption in financial markets. You know how the Fed operates, and you know how the market responds to the Fed. Are you getting any report in your end that there would be a severe negative market reaction if she were removed?
It's interesting because we have seen a lot of analysts write that and suggest that would happen. We haven't seen any kind of real reaction yet, maybe because the markets haven't expected the president to succeed. But if the court rules against her, it's very possible that it could, because at that point, then the president, in theory, could fire anybody, including Jay Powell, on the Fed. But what's interesting in this filing, Romaine, is that they cite a 2009 law review article by Brett Kavanaugh, who's now on the Supreme Court, who said at the time it makes sense to carve the Fed out because of its independent nature. Because if it were not independent, it would cause chaos in financial markets. And so it looks like they already have one justice who might have ruled against her, who has, at least in the past, written in favor of the case that the Fed is making, or that Lisa Cook is making. The Fed itself is staying neutral.
All right, Michael McKee down in Washington, of course, keeping an eye on that case, working its way through the Supreme Court. Meanwhile, we're keeping an eye on the skies over Europe, NATO aerospace to be specific, and the recent incursions by Russian military jets. When we come back, a conversation with the Secretary General of NATO, Mark Rutte. Stick with us. This is Bloomberg. Welcome to our Bloomberg audiences across television and radio. A big focus on the United Nations General Assembly here in New York, and a big focus on the skies over Europe. Joining us right now is the Secretary General of NATO, Mark Rutte, joined right now by Bloomberg's editor-in-chief, John Nicholthwaite. John.
Thank you. Mark Rutte, thank you for talking to
Great
Bloomberg
to be,
once again.
To be on the show.
Can we begin with all these incursions by Russian fighter jets and Russian drones into NATO airspace? And Poland, Estonia, Denmark, those sort of areas have been hit by this. And we have a report today that Britain, France and Germany have told the Russians that if that happened again, NATO, particularly with the jets, would shoot them down. Is that your understanding as well, or you don't know?
Well, this type of messaging is taking place all the time, of course, informal. So not for me to comment, of course. But hey, let's face it, we have trained and prepared for these situations, and our fighter jet pilots know exactly what to do for 50 years now, from the Soviet days, now with Russia. We have had these incursions before. They will assess the danger, and if the danger is such that they feel they really have to take down the plane, then they can. But they can also decide that there is no imminent threat, and then they will escort them outside of the airspace.
I think the message has got through to the extent that you don't expect the Russians to do it again.
But again, there is a bit of a risk that we're all getting now thinking, hey, we need new rules or whatever. Yeah. The rules are there. We have our military people, our military commanders have all the rules at their hand, have all the authorities they need to deal with these situations. And this is not new. We are doing this for tens of years, decades. And we have seen this from the Russians. It is reckless, it's unacceptable. We're still assessing whether the drones in Poland and the fighter jets in Estonia, whether it was intentional. We don't know yet. Yeah. Still being assessed, of course, with Copenhagen, with Denmark. I spoke with the Prime Minister this morning. There we are also still assessing who was behind this. Also very worrying what happened there, obviously, and we're all working on that. But when it comes to these fighter jets, that's not new. It's bad, it should stop. But our pilots know what to do, and if necessary, they can do the ultimate.
Is there a difference, though, isn't there? Russian, with the fighter jets, there seems to be quite a clear policy, as you've said, that's been for years. Russian jets should not come into NATO airspace. The drones is much more complicated because there tend to be lots of them. They're hard to defend against it. And there you seem to have a kind of, there's the intentionality problem that you pointed out. You know, is this on purpose? Isn't it? But another big one is just having the kit to deal with them.
Exactly.
Because, as I understand it, what would happen at the moment is you might have to use a very expensive missile to shoot down a very cheap drone. Is there a kind of kit problem with this as well?
In the short term, yes. And by the way, I was very proud of the Dutch fighter pilot last week who took down, or 2 weeks ago now, who took down these drones in Poland, F-35 pilot. And it's exactly what we need to do, because first of all we have to prioritize the safety of our people. Yes. But you're right, it is not sustainable that you would take down $1,000 or $2,000 costing drones with missiles which cost you maybe $500,000 or $1 million. So this is why our Supreme Allied Commander in Europe, together with the colleague working on transformation, all of us in NATO are rapidly developing the technologies, learning from the Ukrainians, and we will start to apply that new technology over the coming weeks and months to make sure that next to the more traditional way to deal with this, we also have this drone interceptor technology at our hands.
I know this is not some, you've only done it for a year or something. You look back, do you think NATO in some ways has been slow to react to the new reality of drone warfare?
I don't think so, because we have this joint center together with Ukraine, JTEC, which is based in Poland, where we take all the lessons from the Ukraine war. Ukraine being in war is 2 or 3 weeks ahead of the Russians, and they, at an incredible speed, innovate during warfare. So we can learn from them. We will adapt as soon as possible. And in the meantime, if there are drones in our airspace, we will still take them down. We will protect our people.
Is part of the problem here that actually it's Ukraine which is really good at making these things, but they're the people who most need them. So for the rest of NATO, it's hard to source this kind of kit.
Well, the Ukrainians are proud, of course, what they can do, and also to help us supplying that technology. But you're right, of course, they have to prioritize their own safety. But we have also other ways, of course, to get our hands on this type of kit. So we're working on that, also developing, where necessary, the technology ourselves. So this is all being processed now. So we are really stepping up, and this is why we launched Eastern Sentry last week. Eastern Sentry is there to move from policing to air policing to air defense on the entire eastern flank, with the traditional means. But also figuring in as soon as possible these latest anti-drone technologies.
Quite another thing which happened this week was that Donald Trump seemed to, well, he did change tack, and he suddenly said it's possible for Ukraine to get back all its land. What do you read into that?
Well, I think that was a fantastic post he made 2 days ago. He mentioned Russia as he called them a paper tiger. And then the Russians, for a full day, have you seen that? A full day saying, we are not a paper tiger, we are a bear. Hey, if you are a bear, everybody will notice, so you don't have to explain that. So probably they are not. Probably the president was right, and it hit a nerve in the Kremlin, and potentially at the highest levels in the Kremlin.
But there is an issue there. The last time I looked, Russia is still advancing on the ground in Ukraine.
Very slowly. very slowly, and they have lost by now 1 million people, dead or seriously wounded. They lose now in 1 month what the Soviet Union lost in 10 years in Afghanistan. This is what now the Russians are losing in 1 month. This is not sustainable, with only very little to show for it. The problem is that whilst they are not competent to get this done, that still if you have a president willing to sacrifice 1 million people, we have to prepare ourselves for what they are willing to do without lots of success, but still trying to create difficulties for us. And first of all, we have to make sure that Ukraine is in the strongest possible position. So I really commend what President Trump is doing. He also opened the floodgates, as you know, a couple of months ago, of U.S. kit, both lethal and non-lethal, into Ukraine, paid for by allies. So we are working on that. This is crucial stuff Ukraine needs. So in that sense, I think US, the President, Europe, NATO working together is a strong signal.
Is the weakest point of Russia actually the economy? With a lot of reports coming out saying the Russian economy is not including. We've done some. The Russian economy doesn't seem as strong. Do you think there is a sense that Putin is perhaps stronger on the battlefield than he is economically?
And he's not strong on the battlefield either, because if you have so many losses and you only gain a couple of square miles a week, I mean, nothing to show for it. But I think you're absolutely right. The economy is in difficulty. We see the long lines now waiting at the gasoline stations to fill up the cars. We have seen the Russians deciding to bring down the exports to countries like India and Turkey, oil and gas, etc. And this is also because the Ukrainians are successful in targeting the Russian oil infrastructure. And it is famously difficult to get an oil refinery up running again after it has been hit by a missile or a drone. So the Ukrainians are good at this. I always thought that they had this fantastic central banker somehow in Russia who was able to paper over the problems, but I think she cannot any longer. And it's now the cracks are showing. And the Russian economy is in difficulty. You're totally right.
There's been talk of, from the Ukrainian side of, Russians should prepare to live in shelters like they do. Does that sort of talk help? The Russians should prepare to live in shelters if, the NATO starts supplying more long-range weapons, that Ukraine would be able to hit deeper into Russia?
Well, I should not speculate about that, I think, in public media. But obviously, we are in constant discussion, the Americans, the European allies, with the Ukrainians. How can we help you best? And all options are always on the table. But obviously, we should not speak so much about that in public.
Do you worry at all just on the battlefield, going back to that? Yes, it's very obvious the Russians are losing huge amounts of people, but they still have managed to replenish them. That Ukrainians have that problem with the amount of materiel they have, partly the weapons you've talked about, also getting enough people to go forward, that problem about recruiting young soldiers. This is the first time anyone's ever tried to fight a war with old soldiers.
Yeah, but first of all, when it comes to the weapons, with the US supply, the Czech ammunition initiative, you have the Danes and Lithuanians who started this initiative to directly source from the Ukrainian defense industrial base. There are some indicators now saying that Ukrainians are able to up to 50-60% source what they need from their own defense industrial base. And then on the people side, I discussed this also with the President Zelensky this week again. They are not doing that bad. They really are catching up and keeping close to what the Russians are doing. And the Russians are losing 4 to 5 times more people on the battlefield than the Ukrainians are. And because of this crazy way of warfare the Russians have decided to do.
This other big thing that happened this week was Friedrich Merz just said that it's fine to take maybe 140 billion euros of frozen Russian assets, which hitherto Germany's been pretty reluctant to touch, to use that to help finance. Is that a game changer?
Yes, well, I think I was reading that opinion piece. I think it was on the FT website and by the
reputable competitor.
Yeah, sorry. But next time he will no doubt publish it. The Economist or sorry, at Bloomberg, and no doubt. But I think it is an important step. I must say, in the division of labor between NATO and the EU, this is more being dealt with at the EU side. Of course, I have a very close relationship with Ursula von der Leyen, the President of the European Commission. So this is not something I'm dealing with every day, the Russian assets. But of course I follow it closely, and I thought, hey, this is a development. And this is probably a way to work around some of the legal problems to get access to the assets.
Is that what you spend a lot of your time trying to do, is that bit, that interconnection between money, which Ukraine needs, weapons, which then, as you said countless times, are all spread out across different parts of NATO, and then finally that question of the front line?
Yeah, I mean, in the end, what we need to achieve is for Ukraine to sustain in the fight and to be in the best possible position when peace talks would start. That is weapons, that's money. It is, of course, making sure that when it comes to the pressure on the Russians, that when it comes to sanctions and all that, is also more on the EU side than NATO. But I'm really impressed by what President von der Leyen is doing now, working with Secretary Bessent, the White House, but putting more pressure on the Chinese. Of course, we have the discussion on cutting off the oil supply from Russia into Hungary, Turkey, Slovakia. Not easy, but all working on it because we want to make sure that the Russians don't have access to either any of these sources of income. By the way, the shadow fleet, also important. So we're working on all that. Sometimes NATO in the lead, sometimes the EU in the lead, and also in close conjunction with President Trump and his team.
One sort of flip side of what Trump said this week is it would seem that a peace deal in Ukraine is as far away as ever. Is that your reading of it?
Well, the problem is, of course, that he, and I'm really commending for that, he broke the deadlock with Putin. He started to dialogue with him. He had the meeting in Alaska, testing him. But somehow we have not been able yet to get them to the table. And there should be a table not in Russia, but somewhere in the world where at least Zelensky and Putin are sitting down and discussing the difficult issues. How to end the war. And Zelensky is willing to do that. Putin clearly is not. And that means that we have to up the pressure on the Russians to make sure that he will come to the table. And I'm fairly confident we will get there at a certain moment. And the President's efforts here are extremely important.
You've been very good at praising and keeping Donald Trump on side. Do you think that you've changed fundamentally the way he looks at NATO? I mean, when you came in, there were a lot of doubts. I know Jens Stoltenberg was a very good leader as well, but there were a lot of doubts about how Trump saw NATO. Do you think fundamentally now he is committed to NATO in a way that...
Well, you know, it was absolutely clear what he felt. I mean, I was Prime Minister when he was Trump 45, and we discussed this many times. He was always in favor of NATO, and Trump 47 was in favor of NATO. But he had an expectation. The expectation was, hey, you guys in Europe, you have to spend the same we are spending. What Jens Stoltenberg did, he started this process in NATO, assessing what do we need to be able to do if Article 5 would ever be triggered. So this is called the capability targets. Each country, what do they have to deliver? This led to the 3.5 hard defense spending, 1.5 defense-related spending, this total of 5%. When in The Hague, under President Trump's leadership, NATO was able to agree on this 5%, this irritant was gone. This was there since Eisenhower. And he was able to solve it. So I think it was one of his biggest foreign policy successes. So he was already committed to NATO. But this irritant, this big pebble in the shoe was there, and it had to be removed.
I think arguably NATO is as strong as it has been for several decades since the end of the Cold War. If you look at all the things we've talked about, you have countries, saying they will take on Russian planes coming to their airspace. You have people pushing up towards that 5% target. You have a much more committed Europe in terms of what is happening. Do you feel much more confident about NATO now?
Yes, I always felt confident about NATO, but I think President Trump coming into office has really helped because I spoke to many countries in November, December, not yet on 2%, all 2% from 2014 we had to achieve by 24, 25. Who told me, difficult, Mark, I'm not sure we can get it. Oh, how do we do this? And then Trump came into office in January, and from February, March, the phone calls came in. All countries not in 2% said, we're going to get to 2% this year. And then we came to the NATO summit, and we were able with 32 countries to agree on the 5%. Not only because Trump needed this as a win to show to the American people that we are equalizing the spending between the US and Europe, but also in Europe and in the US and in Canada, because we have to defend ourselves against the Russian threat, the Chinese challenge. It's there, and we cannot do that with 2%. We have to get to that 5%.
Well, Rutte, it's very generous and perhaps shrewd of you to share the credit for this with President Trump, but thank you for talking to Bloomberg.
Thank you for having me. It's a real pleasure.
Back to you.